So now that when we turn to the US and look at some of the data points, we're going to look abroad a bit and then pull back into the US and just to rehash just what is happening with US Treasuries and how these drawdowns continue to happen as you look at the losses in general. There's that fear of, well, what does it need? What do we need to see in terms of activity? And now just a headline came across. So Goldman sends employees in India home as COVID cases rise, just to consider what is happening in Asia and some of the pressure that we continue to see. But again, it's going to continue to push up, and that's why India and some of these other areas in Asia are going to face some of these problems. Then when we look at the Philly Fed and some of the overshoot that we see, so China official manufacturing index has come down while the Philly Fed index has ratcheted to all-time highs. And there's a bifurcation as to, well, what is the calculation? So we do have some benefits in strength in employment. We do have delays in inventories. We have prices received going to 2008 highs. We have prices paid going to 1980 highs. So these are things that, again, should start to come down, but are going to remain elevated based on what we talked about with the EIA show. Now you have the Suez Canal. There's a lot of problems that are just going to that cause these issues in the supply chain and just keep those prices elevated. So then when we look at the indexes, so when we look at volatility, the one that concerns me the most and was really what started to get me more bearish on not just the market, but everything in general, was the move up in the MOVE index. And it's just looking at bond volatility, because typically whenever bond volatility goes up, the Fed just buys more. And that is kind of capped out at this point. And there's been, with inflation starting to peak its head, as much as the Fed says they want inflation and they want to continue to be supportive, they also don't want to overshoot inflation. As we have more fiscal stimulus, we have now a talk of an infrastructure bill of $3 trillion. We already have $1.9 trillion in the market. So are you really going to go out and buy, instead of 120 billion, are you going to buy 160 billion? And for what? And that's where we're starting to see this bifurcation where the VIX comes down, or the way that we're measuring the equities, while the bonds are moving up. And I think at this point the bonds are going to continue to drive some of the volatility in the equity market. And this is just looking at some of the indices. So some of the high frequency data points, just want to highlight where you can see COVID cases remain elevated in South Korea. The stringency index has come down to about 58, but still really slow, still not moving all that quickly. And then the vaccine doses still remain, repressed in terms of getting it into the system. But we do have retail starting to peak up a little bit. We do have expressway traffic starting to move a bit. So again, people are tired of these delays and they want to get back to normal life. So now you have an increase in some of these COVID cases. How much of that do we start to pare back? And when we look at South Korea, we don't think it pares back. It just kind of stays here where we had some nice improvement and now it starts to flatline, but we've seen an increase in PPI, their export prices, which if you think about where we're getting a lot of our stuff, it's going to reverberate in our system because those higher prices will get passed on to the US consumer. And now looking at this a little bit differently, when we look at India, so when we look at India, you can see the increase in new COVID cases really starting to ratchet up, total active cases starting to go up, but the lockdown index has now really spiked back up. And it's more not a national level, it's on a state by state or provincial level. And now Goldman is sending people home. Mumbai has seen a very large increase, which is obviously one of their financial hubs. So these are things that are going to weigh on just how much activity do we see out of India, how much of this limitation will we get on just activity as it impacts consumer sentiment. But again, these are things that we're going to continue to watch, which all filters down to what is happening in the U.S., where we do have those increases in cases. New COVID deaths are going to continue to move in the right direction as that lockdown index continues to improve, as Pad 5 continues to reopen. This is going to be some of that positivity moving through as these job postings have gotten a bit better, which again, obviously we'll talk about in a minute. But when we look at the central banks and central banks in general, when we look at the commentary, the issue has really shifted to employment, because as we've said from really the start of this, when we go back to just March of last year, employment is a lagging indicator. And our fear was, or what we thought was going to happen, was employment was going to go from a lagging indicator to a real-time or leading indicator. And I think seeing this come out is testament to the fact that they were hoping to see an employment rebound faster, and we're just not getting that. It's starting to get a little bit better, but it speaks to how bloated these companies were in 2019. Again, we were bearish in 2019, and COVID was cover to fire people. And you're not going to be in any hurry to hire them back. And now you're getting this bifurcation in skill sets, which is keeping some of these job postings just languishing in there, and we're not seeing it get filled. And now they're trying to maintain this solid monetary policy, but now inflation commentary is picking up again because we're starting to see it ratchet up. So your mandate, at least in here, is employment, inflation. Employment's not getting there, and you're starting to have an issue with inflation. So how much can you really drive this home to generate employment before you start to have an overheat in the economy? And that's where we're starting to get this bifurcation of this mandate and some of the issues that are going to be faced over the next few months. In the meantime, SPACs are going off at the highest clip ever. So now, so far in 2021, $79.4 billion this year. So we've actually taken out the high of all of 2020. So people are going to try to get free money and liquidity wherever they can. And here is your perfect example as people look for ways to put their cash. Why? Because they're all rich. And when we look at just in general, so I have beaten this to death, and I will continue to do so when we talk about recovery and what does it look like. The top 1% are 35.2% of the household increase in wealth. Expand that to the next 9%. We're now at, if you just average it 35 to 35, we are now at 70%. So 70% of the U.S. wealth growth has been in the top 10%. The next 40% is 26%. And then the bottom 50. So 50% of the rest of the country has at 4.1%. Again, this is where we continue to see this bifurcation of what is a recovery, what does this look like in general, and this is not just a U.S. issue. And we'll talk about the European side in the European segment on segment 4, because this is where we continue to see the overhang for a long-term sustainable recovery, especially when we're not getting the job growth at the lower end of the scale. And when we think about inflation and what are some inflation drivers that are clearly going to hit the lower end of that scale more, we can just look at freight rates. As freight rates continue to remain at all-time highs, or at least going back to 2016 at highs. And again, this is a cost. This is a cost that the company is paying, and they're going to try to recover as much of that as possible. As diesel prices go up, as bunker fuel prices go up, that just keeps this elevated, as that is a pure pass-through. So you're just going to continue to pass that down the line. Again, indicating where inflation is going. It has started to hit, but we're still at that infancy of it getting pushed to the downstream and really resonating with the underlying consumer. So now when we look at companies mentioning inflation, again, companies are talking about it because they're looking at their prices. So if they're looking at their prices, they know they're going to pass this on, or they're going to pass through as much as they can, which as the commentary increases, the CPI goes up because they're telling you what they're going to do. So it's not like it's hiding. We all know it's coming. So to kind of say it isn't is just missing that component of how this is going to move through the supply chain. So then when we take the inflation expectations, well, obviously they're moving to all-time highs because global CPI is going up because we're watching PPI, we're watching CPI, we're watching shipping rates, we're watching oil. All of these things are in commodities in general. I shouldn't just single out oil. Commodities in general are moving up, and now we're back to those May 2004 highs at the end of, or at least closer to the end of the bond bull market, which is just going to send rates to that extreme, keep levels and hurt the emerging market side. And it's not just in one spot, because then when we start turning to, okay, well, what's happening with poly? So let's look at plastics. Well, plastics are back to highs. And if you think about just what we normally spend money on, have benefited the most from technological innovation, moving supply chains. If you just think about how we went from the U.S. manufacturing to China. Then we went from China to the Philippines. Then we went from China and the Philippines to China, Philippines, Malaysia, Pakistan, and India. So where do we go next? We've maximized the supply chain. Now we're starting to see those price increases, and how much can technology continue to cheapen? Now it's just terminal velocity. We've gotten to a point of, can we really get that much more power for pennies cheaper, or are we going to see pennies increase? And that's, again, looking at just the foundations, tin, copper, plastics, all of that has been going up, and that's going to result in just inflation in places where we're just not used to seeing it. So that just leads us again to the year ahead inflation expectations, which, as a shocker, is going up. Now, let's turn this and make it personal for a minute. So let's take the composition of U.S. consumption. Where are you buying? So the share of real PCE from 2016 to 2020 gives you the backdrop. So clearly, when you look at housing and utilities, healthcare services, that's your biggest chunk. That is where you are spending the most of your money on an aggregate. Then you take that and say non-durable goods, gasoline. Then you want to look at food at home. So food inflation is going up. We know used cars are going up. We know housing is at a all-time high. We know that healthcare services continues to ratchet up. I know my healthcare goes up every year. So again, where are you not seeing this? And so am I buying clothing and footwear? Well, not to the same level, but that's 3% of my spending. So 3% of my spending is down, but what makes up 16.7% is now up. Am I going to recreation and services? Well, no, I'm not going out to dinner as much, but I'm eating at home a little bit more. So that's driving food up. So again, you're just getting these shifts where you're doing less in one and more in another, but you're starting to see those increases across the board. And I think the backdrop here is indicative, especially when you look at durable goods and just what we're importing, PPI abroad, import prices, all of these things are going to get pushed down, and we're going to see those prices continue to go up. So that 13% that you spend on a regular basis, or at least at a more normal clip, is becoming a bigger problem. And that's why when we look at the Los Angeles, like as we talk about in the EIA show, this has started to normalize, but you still have a long period of time. As we get reopenings, as we get some of these things coming through, this will expand some of the capacity to move product and to try to minimize some of those price increases that we've seen on the supply chain, but it's not going to go away tomorrow. And when you look at just where we sit overall, and now you're getting new COVID cases in Europe and India and Southeast Asia, we're not going to see a reversion back to the mean, because there's still that lag in the supply chain. We got very used to at-time delivery. Well, now we're struggling with at-time delivery because we don't have that cushion. We don't have that backlog, which is, again, coming through and creating these underlying issues. But even when you consider all of that, the FOMC continues to say that the projections of growth remain strong. When you're looking at what happens in 2021 as we go forward, and then the PCE inflation, they think it spikes up and then comes back down into 2022, 23. But how much new liquidity is in the market? We have the fiscal stimulus, we have monetary stimulus, we have, if GDP is that strong, well, velocity of money is going to pick up. So if velocity of money picks up, that has been this overhang. But what is velocity of money? But the way the dollar moves through the economy. So when you look at the price of a unit of GDP divided by the money supply, well, the money supply, the denominator, has gotten massive. But the prices have gone up, but GDP hasn't. So if you're expecting this huge surge in GDP, well, technically you should see money moving through the system. You should see the acceleration. And now not only are you worried about the inflation side of just pricing, but now you have velocity picking up. And again, this is where it starts to get a bit more complex. But when we look at the economic sentiment index for these 5 specific questions since March, people are starting to feel a little bit better on personal finances. Obviously, you're getting more money, new home, but in general, the U.S. economy and personal finances are at a height, but new jobs remains depressed. Again, that is going to weigh on that economic prowess when you have the new job side becoming that problem overall. So this is just a snapshot of some of the recent economic indicators. Jobless claims will go through. You can see that they remain elevated. Here you can see that Philadelphia spike. But the Chicago Fed National Index came in negative. Existing home sales were down versus more than estimates. You have current account balances at some of the worst it's ever been, or at least since 2008. Then you look at new home sales, in month over month. That's where we start to see that bifurcation of this is February data. So just think about the freeze-offs. As I've said it a million times, 73% of the world, of the U.S. was under snow, some sort of storms. So clearly less is going to happen. We need to look towards March to say, okay, well, how much of that was weather and how much of that was holding back until the stimulus checks hit? So you not only had a weather problem, but you have a stimulus problem. So again, that's where we're going to have to look at what does March really bring us. Because then, not surprising, when you go to durable goods, a surprise to the downside. Durable good orders were supposed to be at 0.5%. They came in at negative 1.1%. Now, that's a bit more concerning because those are orders. So that's looking forward. So you're not taking delivery in Feb. You're looking to take delivery later on. So you can call, you can, so clearly weather's going to impact that, but it's not going to be to the same degree because you can make phone calls and the weather only hit in the back end of that month, not at the front end. So again, that's a bit more concerning and durable good. And then when you start going through the line, then you look at PMI remaining strong on the manufacturing side, coming in at 59, but estimates were 59.5. Services of PMI were supposed to be at 60.1, came in at 60. U.S. composite was at 59.1. So a net positive, but again, slightly below estimates. And this is looking further into March. Now, when you start looking at some worldeconomics.com, prices charged index continues to remain elevated. And you can see it's been elevated since April of last year. And it's not going down, it's only going up and accelerating and growing, and it's compounding on itself, which again leads to the bigger problem in general, because we haven't even really hit true base effect problems, especially as you get gasoline and some of the back end side of the rise in oil. Then when you look at staffing levels, staffing levels are still declining. So this is that separation of what is actually happening at the meat of the market. When you start looking at jobs and job growth, we're still getting this friction where some data points to expansion, some data points to stagnation, some data points to fairly small declines. So net, it's either going to be a small increase or just steady state, which is again not projecting or moving us forward in general. And now when we look at the Chicago Fed national activity, as we showed before, we actually got a decline. So we're actually moving in the wrong direction. As you can see, we had that nice pop from the stimulus, and then we continued to move down. Now we're obviously going to get another pop from U.S. stimulus, but as I've been saying, PPI and cost have gone up since April. So when you get that money, it's not going to go as far, and you're going to essentially just refill the what you've pulled from savings, leaving you with this slowdown. Because when we look at production and income, that was negative. Employment was essentially flat. Personal consumption slightly down. Sales and orders slightly down. Again, kind of moving in that wrong direction. And when you look at manufacturing vendor lead time, it's at an all-time. It's going back to 2005, you're at a high. Looking at raw material inventories, you're at a low. That's cost. And this is cost that is not going away. And you're going to have to realize this cost, and then you're going to try to recover as much of it as you can. Now, you can't push it through all at once. That's impossible. But you're going to try to increase that in stages to try to recover as much as you can. So again, weakening earnings, but just keeping that CPI moving in the upward trajectory when you look at the underlying data points, which is why when we start to pick and parcel, so this is current composite. If we look at manufacturing, the manufacturing side, you can see that has started to slow down. Employment has, again, steady state, still expanding, but steady state. New order volume was unchanged, and order backlogs fell to 11 after 18 the prior month. So order backlog slowing, new order volume flat. Employment flat, again, trying to lead into the indicators of what is to come, which would remain slow. So now let's look at sales. Well, home sales have started to slow. This is something where, Feb home sales were negative 18.2% versus an estimate of negative 5.7%. Monthly drop was the worst since 2013. Medium home prices, while that was going down, they increased 5.3% year over year to $349,400. Again, inflation. So we're going to say some of this was due to seasonality and weather. But again, that is a big miss that needs to be watched, because are we going to start to see some slowdown in the real estate market? Now, this is looking at existing home sales, a little bit different. So February was down negative 6.6% versus the negative 3% estimate. Overall levels still healthy, but at a 6-month low. Higher rates and asking prices hurting affordability. Shocker. So again, as we see the 30-year going up, that's going to make some of the expenses go up when you consider mortgage rates, as the 30-year is now over 3%, which is just going to limit the amount people can actually afford and maybe cut pricing in general, or maybe slow them down a bit. And that's why when we look at fourth quarter current account deficit expanded to $188.5 billion versus $180.9 billion in Q3, now at its widest since 2Q of 2017. Goods deficit widened to $253 billion versus $247 billion. Service surplus narrowed to $53 billion versus $46. So clearly, when you look at it, when we look at where this is, we are sitting there at, since 2007, not 2017. So the nominal account balance issue is continuing to get worse as prices are going up, as delays continue to increase. Again, speaking to where are we going to see inflation over the coming few years. And this is when we start looking at Chase consumer card spending. You can see that this is going to, a little bit of a chart crime, because obviously there's a base effect here. So the change from pre-COVID trend, I think, is more important versus the year ago, because the year ago is up from obviously the base effect, but the change from pre-COVID is still moving in the right direction. And this is looking at March. So as people have gotten their money, they've started to increase spending, but it's still not over pre-COVID trend. So that's why we have to look at what is that pre-COVID trend, which is they're still down 4.4%. Again, speaking to that bottom 50% that still don't have any wealth, even though we've seen this massive wealth creation at the household level. And this leads to, what are people buying? And this is really, I thought, an interesting chart looking at the product consumption, because people have switched brands, not because they wanted to, but because it wasn't available. I mean, this has become an issue, and now that we're at 23 minutes, people that watch this long will get a little flavor for some of the things that I like to nerd out on. But my wife and I started watching Summer House, and we've caught up. And there's one of those products, Loverboy, which is just a hard seltzer or hard tea, and he is talking about how he couldn't get aluminum cans, so he couldn't sell product. So it's not that somebody didn't want to buy Loverboy or his product, they couldn't get volume. So that meant that if you can't get that, well, can you get a hard cider? Can you get a different hard tea? Can you get a hard seltzer instead? Because you went to the store to go buy something. You're going to buy it because you want that product. So are you going to leave and come back hoping that they have your product, your brand? And the answer is no. And that's where this is something to watch to see, have new consumer habits been created? Did people try another brand and like it? And this is going to be interesting to see how the consumer and retail kind of shifts under this guise. And then rounding it out, when we look at jobs tracking data and the alternative data, here you can see just kind of where things are shifting, where we should start to get an increase in jobs, but you continue to see that it's not as ratchet up. It's just this very gradual move. And as we continue to talk about with some of these data points, that we're just not seeing this really exciting shift higher in employment. And it's really kind of a muted move, which is going to become, I think, an overhang for where does this recovery really take us. And now, as we go into what's happening with jobs, that's when we go into the next segment, looking at work from home and how is the consumer changing their patterns, not just on the consumption side, but also how are they working and what does it look like going forward.